and welcome to this economic forum. Today, we will get a glimpse into 2013, at least through the minds of 5 very prominent economists and market investment experts. My name is David Gentoli. I am chairman of the Board of Trustees of the Missouri Council on Economic Education, the organization that is sponsoring this event. And we are here today as a result of the Council's collaboration with the University of Missouri St. Louis and also the Federal Reserve Bank of St. Louis. And this event is happening thanks to the hard work of a committed group of individuals. And I'm just going to run through their names real quickly, but they certainly deserve acknowledgement. Mike English, Nancy Gestenkors, Karen Goodman, Gerhard Petzold, Grant Black, Sharon Laux, Alan Robbins, Ken Katziff, Mary Suter, Dan Thornton, Janine Hogan, and Mark Gravenstein. We thank you so much for organizing this, and there was really quite a bit of work for that dedicated group of people. So what is the Missouri Council on Economic Education anyway? You heard a little bit about it here in this nice video, and we've been around for a long time. This says 60 years. And our mission, though, is the most important. It's to promote economic and financial literacy. And as the last 5 years have very clearly demonstrated, the prosperity of our country depends a lot about the individual financial decisions that people make. And so, obviously, the decisions that people make personally is a function of what they know. And as you also saw from this video, and as you know from your own personal interactions with perhaps relatives and other people you meet, that a lot of people just don't have a clue about, a lot of adults just don't have a clue about financial decisions. And so what we're about is providing students in K through 12 schools with a strong foundation in economics and personal finance that presumably will lead to better financial decisions as they reach adulthood. And if you were in the group, if you had a chance to hear some of the students ask questions of our panel of experts today, you'd be amazed at the knowledge they already have. The Missouri Council works throughout the state to improve financial literacy. And we do have, as I mentioned, the students were next door in a Q&A session. We have about 100 students and teachers, high school students and teachers here today to join us, thanks to the generosity of our sponsors. The Missouri Council on Economic Education is a not-for-profit organization that delivers student programs such as the stock market game. Maybe some of your kids have participated in that. The National Personal Finance Challenge. The Council also works with centers for economic education in universities across the state, delivering other economic and personal finance programs to educators. In St. Louis, we work closely with the St. Louis Center for Entrepreneurship and Economic Education. That's on the campus of the University of Missouri St. Louis. At this time, I want to acknowledge 3 people. One is Karen Goodman. Where are you, Karen? Would you please stand? Here's Karen. Karen is the chair of this event today. I'd also like to introduce Grant Black. I think Grant is over here at this table. Grant is the head of our Economic Center at the University of Missouri St. Louis, and also Mike English. Where is Mike? Here's Mike. Mike is president and CEO of the Missouri Council on Economic Education. So now it is my pleasure to introduce Alan Robbins. And Alan is the chairman of our local St. Louis, Missouri Council Board. Alan?
Thank you. It is now my pleasure to talk about this organization, which means so much to me. Because the Missouri Council on Economic Education is a not-profit organization, we rely on the generosity of sponsors to offer many of our programs, including today's event. We are grateful for the support of our platinum sponsor at this event, which is Lindenwood University. Our gold sponsors are Edward Jones, Signature Medical Group, Northwestern Mutual, and our silver sponsors are the Missouri Bankers Association, Stifel Nicholas, BMO Harris, and our bronze sponsors are ClearPoint Credit Counseling Solutions, Stone Carley, and Guilfoyle Putzel and Shoemate. It is indeed a privilege for the Missouri Council on Economic Education to be involved in this important event. It is now my pleasure to introduce the moderator for today's event, Julie Neiman. Julie is an experienced financial analyst with over 40 years in the investment industry. She currently serves as Executive Vice President of Smith Moore & Company. Previously, Julie has been with Waddell & Reed, United Mutual Funds, University of Missouri St. Louis, Edward Jones, Stifel Nicholas, Huntley Securities, and R.T. Jones. She's a member of many professional organizations and is deeply immersed in the St. Louis community. Julie has a BA from Fontbonne College, St. Louis, and an MBA in finance from the University of Missouri St. Louis. Julie is an author, is frequently seen on St. Louis TV, and heard on St. Louis radio and investment topics. Her quotations and articles have appeared in Fortune, Wall Street Journal, New York Times, St. Louis Post-Dispatch, to name a few. Julie has previously served as moderator for local economic forums. Please welcome Julie Neiman.
Well, let's see, we'll get our graphics going together here. Does anybody feel like this is a bull market? I don't know. We're actually experiencing a fairly good bull market, going through a little correction right now, but the stock market keeps going up, and here's my anxiety. Why? Well, bottom line is there's no other place to put your money, and that's probably the key thing. When you've got interest rates at zero and all your certificates of deposit are earning a poke in the eye with a sharp stick, where's the money going? Into the stock market. When we began 2012, in fact, last year when we were talking about where's the market and the economy going, 2012 is when locally I started giving my forecast, which was, here's the exciting news. It's not going to get any worse. Not that we were going to grow, but it wasn't going to get any worse. And the encouraging signs that we're looking at, well, recently we saw a little bit of semi-positive news that the unemployment rate had actually gone down a little bit. But growth was absolutely nowhere in evidence. When you look at the real estate markets, prices are beginning to tick up a little bit. There's a lot of pent-up demand out there, and low interest rates on home mortgages, a wonderful thing. So this economy is moving ahead at less than blazing speed, and it looks like it's going to be persisting this way for some time to come. But there are a lot of things out there that could be extremely dangerous, and we're going to be talking about them today. Just a sudden crack and things could get really ugly all over again. We had our young people this morning talking in the conference next door, talking everything from the budget deficit to the fiscal gap to China trade wars with China, to you name it, unemployment really being very big on their minds. What happened with the government? Well, virtually every single approach that we've had so far has been pretty piecemeal. So we've got other problems facing us too. Did we really take care of the problem? One key thing we know that Congress has to do is to get their priorities together. Already on record, Congress has gone down as the worst one in modern history. So this is a prayer lunch meeting, I hope you all know. We're going to join hands and pray that Congress can actually get their act together. Well, also our economists today are going to be talking about the fiscal cliff, which everybody has a sense of impending doom. So we're going to have a long discussion in this area as well. One thing we do know, taxes one way or the other will be going up. We can hardly wait to see what that's going to entail. So today we have three economists who are going to be speaking. The glass is half empty, the glass is half full. What glass? We're going to have different economic perspectives from each person. Our format today is we're going to have each of them give a discussion about their forecast for the future, and then we'll open up to questions and answers. And I know at the end we'll have a whole boatload of questions. Passed around will be on your tables. You'll have a tablet. You also have a pen. Please write those questions out. We'll have people milling around, picking them up from you, and we plan to open it up to questions for as long as you want. So thank you very much, and we'll get moving. Jeff DeAngelis, who is president of Mason Street Advisors, LLC. This is a subsidiary of Northwest Mutual Insurance. He originally got his start in the fixed income and the bond side of the business, so we have good expertise along that area. One of his very favorite projects is doing volunteer work for urban education for students within urban environments. He's on a number of different boards in this area. As president of the Mason Street Advisors, he is basically doing private money management, institutional money management for the subsidiary of Northwest Mutual. Our second speaker, well, we'll go first of all, just have Jeff give his speech first on what his economic outlook is going to be.
Okay,
Do you have your overheads?
let's see what they got up.
Sorry, thank you.
Good afternoon. I made a note to myself when I was eating, never to follow a Fed president, and particularly James Bullard. But anyway, especially if you're not formally trained as an economist, and I'm not, I'm actually a money manager, and I'm going to try to put a practical perspective on the things we've learned today. I did want to thank the council for having me for economic education. I enjoyed, we had a program just before this with 100 students that have attended this, and the questions were great. We had a great dialogue, and you're doing great work. I can tell we all have shared with amongst ourselves just the quality of the programming, because obviously the high school students had great questions to ask of us. Many of them which we'll try to answer today, but one thing about these kind of questions, they're more rhetorical in nature. They don't generally have an answer. Let me just start, and I will drift around a little bit because, again, I think these are prepared notes that the compliance group signed off on, but I think it's better to have more of a dialogue on what's going on. I know the Fed has talked about being on hold to 2015. Our view is, that's a likely case, but you always look for the unlikely case. And in my business, when you forecast, we start out with a forecast. We have to change it many times because with the nature of our business is to identify the trends or the changes to the forecast that lead to profitability in a trade. And one of the things we think is going to happen is either through a rise in economic growth or through some maybe increase in inflation, although modest, the Fed may have to modify that early. So at least our central tendency is to think of the Fed modifying their policy in 14, not 15. Regarding inflation, we do agree with the Fed that there's a gap in both output and a gap in labor. And one of the speakers will address the idea of structural versus cyclical employment. I'll leave that to him. But we also think that there's the likelihood of some commodity inflation. And we saw this with the Fed's policies of QE 1 and 2, and less so today in QE 3, but we expect that to lead pressure on the dollar, higher inflation in terms of commodity prices, and that could, as the economy starts to pick up or gets closer to the Fed's tendency for growth of 3.5%, make them abandon or restructure their policy later in 14. I think this is going to have very limited effect on employment. Our central tendency is to think that some of the employment is structural, and so barring any other type of innovation or productivity increases, I think people will come back into the labor force, and you'll always be fighting somewhat of a losing battle in terms of the unemployment rate. A lot needs to be said about the fiscal cliff, and I'm sure we'll all talk about it. I think of it quite simply because I have to translate everything into simple context. We tax at about 18% of GDP. We spend at 25% of GDP. That 7% gap will grow to twice what it is today in 10 years. We're at 100% of GDP in terms of debt. That's $15 trillion. At the point 10 years from now, when we haven't done anything to correct this, we'll look a lot like our European counterparts that we're critical of today. So I think something will change. I can't promise you it'll be in the next 6 months. And the tactics, I'm sure, will be very political. But I'm hopeful anyway. And I think we have a long runway in order to accomplish those things. Somewhat controversial in terms of our view is emerging markets were the growth engine of the last decade. And suddenly they sort of stalled, or the U.S. became, at least from an investment perspective, a better place to invest. We think that'll revert back to emerging markets over the next 5 or 10 years. It is odd that people had the view, precisely after the growth had occurred, to place their bet and place their money on emerging markets at precisely the time the money was coming back here. But this environment we're in of risk on and risk off is very unusual. And I don't think it can persist. I think the idea that everyone is chasing beta or just making market bets by entering into risk when it's appropriate and taking risk off the table when it's their view is unlikely to persist. It's almost gambling at this point. These cycles of risk on and risk off are in terms of weeks and months and not years. And I think we'll get to a point where we'll start to price in growth. Emerging markets have higher growth rates than developed countries, and they offer better value, particularly because their stock markets, like in the case of China, are down about 6 to 8% compounded for the last 5 years. So I think we're looking for growth in emerging countries. We're looking for stable growth here, but nothing exceeding 2% for the next couple years. I think, having said that, the compulsion to own dividend-paying stocks and high-quality companies will continue. For large institutions like ours, it's a tremendous value to be able to own the top 100 brands in the world. While we think it's not a great bull market strategy, and we don't think we're really in a long-term bull market, I think the coupon from the dividend on common stocks that are high quality and the marketplace that they have and the reduced risk you have in the downside is a compelling argument, particularly for companies like insurance companies. And that is somewhat, it won't work in a bull market, but it certainly works in this environment. I think it'll continue. And then at some point, and this is the toughest question you can ask, rates have to go up. I mean, the Federal Reserve is pursuing a policy of trying to inflate or to monetize the debt in our view. The reason why they've been successful at keeping rates lower is because there's an output gap. Inflation has remained low. And the other issue, which we can't ignore, is that they've put $3 trillion worth of debt on their balance sheet. For the students in the room, by the Fed putting $3 trillion of assets on their balance sheet, institutions like ours are forced to go and buy other assets. And generally those assets are of higher risk. And that is precisely, as I understand it, the design of the program by the Federal Reserve to put treasuries and mortgage collateral on their balance sheet and force investors out the risk spectrum. And I can tell you, quite frankly, we used to have 30 to 40% of treasuries in our portfolios, and we have 7 or 10% now, and that money has gone into corporate bonds. So same asset class, higher risk profile, and it's merely just the mechanics of trying to buy treasuries and competing for treasuries with other institutions when the Federal Reserve has parked $3 trillion on their balance sheet. So I think that's the kind of thing that you read about, but in practice it actually happens. And then the last thing, which we don't want to get too much into currency forecasting, because I can tell you it is a race to the bottom. It's a question of the dollar, the yen, or the euro, and which country is going to be more accommodative or be more aggressive in terms of making their currency more competitive. So those are some thoughts on that. I'm going to share. Oh, I just got to check the boxes. My administrative assistant is too efficient. I'm going to go quickly through this, but here's my case. It's about the debt. We overconsumed, not just us, but globally. And this is the point that James made about Reinhardt and Rogoff. They've done the work. I think we've all had a standard of living that probably exceeded what we should have, given that it wasn't based on equity, but based on debt. And then the question is, we all know that, and as this debt has increased, it's gone from the private sector to the public sector, but it still hasn't been retired. And what you're talking about when you talk about the deleveraging process, there's been deleveraging in the housing market, and largely that was involuntary. People didn't want to give up their house, but they did. There's been deleveraging in the corporate sector because interest rates are so low. We've transferred a lot of debt that was expensive debt at the high yield or high grade market to a much lower yielding situation, which is much more capable of being financed. And throughout the system, there's been somewhat deleveraging. But then the other side of it is the Treasury is borrowing more and more money. And globally, you can make the same case. And so I don't think we're fully through this cycle. And the reason why the slow growth environment is likely to persist, and the reason why inflation is likely to remain lower, and all these things are related to we have to bring this debt level down or bring growth up. And that combination is going to be difficult. So that's the premise behind our view. These are some slides, they're probably hard to read, but I'll go through them quickly. What you're trying to find is that since the last recession, which is the event date, that purple line is how far personal consumption has risen. The other lines are all the other previous recessions since 1975. So clearly, this is a subpar recession. I don't think I'm telling you anything you don't know, but that's personal consumption. This is non-farm payrolls. This is what's concerning the Fed in their dual mandate. We are definitely not picking up the employment growth that we historically do and the GDP growth following a deep recession. Durable goods, however, and there's been capital deployed, and that's one of the other issues, is that technology and innovation. Capital goods and durable goods have actually held up okay versus other recessionary examples. Consumer credit is flat out on the lows, and you can see that this is the issue about the banking system. We've put a lot of money in the banking system, we reliquefied banks, and what's not happening is that's not translating into credit growth. And there are some signs on the margin of this occurring now, and that is one of the reasons why, like Mr. Bullard, we think housing's in a better situation today, but that money has to leave the bank and go to the homeowner. Single-family housing around a recession. Clearly, this was a housing recession, and a deep one at that. But probably this is the most troubling, and that is the job losses in the post-World War II recessions. And I think this is the issue regarding when people start entering back into the workforce, when jobs become plentiful. I think it's going to be a difficult thing to overcome. So how do we perceive all this? And this is a little dated. Stock market's up a little higher. We think we're in a cyclical bull market in a secular bear. Now, what does that mean? The stock market had tremendous gains between 1981 and 2001, let's just say. And that represented a real bull market. And there were corrections along the way, like 1987, which took 36% of the value out in a week. That was a bull market. What we think happened is, and maybe it was the result of technology, maybe it was the result of overall indebtedness, maybe it was the housing boom, whatever it was, maybe it was the aging and demographics of America, maybe it was the healthcare costs. The opportunity set is now different. And so we expect a very large range, and so a continuation of the bear market. The name of this was The Last Waltz. Many of you probably are too young to recognize what that is. That was a concert held in 1976, the farewell of the band called The Band. And in rock concerts, actually, the headliner goes at the end, but the speech thing, they got the headliner at the first. The reason is we call, for us, it's The Last Waltz. This is a cyclical bull market. When Reinhardt and Rogoff studied this is liquidity driven. This is the biggest disconnect we've seen between valuations on stocks and the economy and the unemployment situation, the growth prospects. So we think there's still more to go, and maybe 13 is the turning year. I was always told to forecast, not rates and dates, and I just did it. I actually gave you a forecast and told you when it might occur. But we think the stock market's in the last leg of a cyclical bull market, and that doesn't mean we're looking for new lows in the stock market. It's just more consolidation until some of these issues get resolved. Home sales, the rest is home prices, and this is all picked up recently, more than it shows by these charts. Labor market weakness. This is interesting, and I think particularly given the topic of this particular luncheon, it's clear that education pays. I mean, a high school diploma gets you unemployment rates of around 10%. So somebody with just a high school diploma is 10% of them are unemployed by these figures, and 1.9% of people with doctoral degrees are unemployed. And the other thing is look at the wages. On average, a high school diploma earns about $626 a week, and a doctoral degree earns $1,550. So for the students in the room, it pays to get educated, and particularly I think as we go forward and look at the world that we're going to be in, one where we talked at the break is that curiosity and like learning for life is going to be a driver of your employment situation as well as how much you earn. CPI, we talked about the 5-year forwards on CPI. The Fed wants to maintain CPI at roughly 2%. It's probably creeping up a little higher than that now. Our view is that it will get higher than that by 14. I'd like to say there's dramatic catalysts for change, but there really isn't. What you see today is probably what we're going to be talking about next year if I'm invited back. So what I think on the direct horizon, cyclical bull in a secular bear market. We're going to pay close attention to what happens on taxes, particularly capital gains. From the short term, those people who are so interested in the short term, which I wouldn't concern myself with, it could have effect on dividend stocks, which I think are attractive, but If they change the tax law, it could mean selling of dividend-paying stocks at the end of the year. There's going to be rapid change on health care. We all know that. We know we can't afford it. We don't know how it's going to change. And then the regulatory environment, which we talked about earlier, so far anyway, the regulatory environment has done very little to regulate the risk of large financial institutions, but has increased the cost dramatically and the hiring prospects of lawyers, since we're focusing on education. Secular bull market, if in fact this thing, if we're wrong and the world changes, I think there are some reasons to be optimistic. I didn't put it on the list, but the most obvious one is a natural energy policy. I mean, you know it, that natural gas is a cheap, abundant resource that could last 300 years in the United States, if only we can convert the distribution and our cars, autos, trucks, all these things to this type of burning of that type of fossil fuel. There's other things like that. So I think we're going to need something different than what we have. We need innovation, we need productivity. It's possible. Never rule it out. I was mentioning to the students when I was in school, they said we wouldn't have oil by 2012. Well, we have plenty of oil, it just costs more. There was all kinds of things. I never thought I'd see an employment rate in the state of Wisconsin at 3.2%, but that happened as well. Now that it's back to where it was when I was growing up, it seems a little difficult, but it was much higher growing up in the recession of the 80s, in the early 80s. So I'll conclude my comments at this point and just turn it over to Julie for introduction of Kate.
Okay, we're going to jump around here. Our next speaker is Dr. Ed Lerner. He's director of the UCLA Anderson Forecast, which provides quarterly economic projections for the nation and the state of California. He's also the chief economist for Ceridian UCLA Pulse of Commerce Index. He holds the Chauncey Medbury Chair of Management at UCLA Anderson, and he came to UCLA Anderson in 1990. He's published more than 100 articles and 4 books. Would you welcome Dr. Ed Lerner?
So thank you very much. I arrived in St. Louis with this cloud of pessimism, but having spent an hour with these high school students, I feel pretty good about the United States. I think we're going to do okay. But I want to offer a different perspective. We heard this Reinhard Rogoff reference twice from both of our other speakers. I don't think that describes the U.S. economy, and it creates a kind of passivity on our part where we just have to accept the fact that we had a financial crisis and not do anything about it. I'm going to tell you what I think we ought to be doing about it as a nation. And I phrase the question, who can save us? And this image is supposed to suggest magical thinking. And down below, it's Wall Street. That's a Reinhard Rogoff view. If something about the Fed can help us out, something that they would do that would make the financial crisis not linger so much. K Street, so it's a regulatory environment, is another fiscal policy that we need to worry about, or is it a Main Street problem? My view, it's a Main Street problem or workforce development problem. And the operative words are structural adjustment and creative destruction. So when an economy experiences a structural adjustment, that means that the assets that used to create value are not so valuable in the new world. That's creative destruction. I'm going to argue that the microprocessor is just killing off the value of high school education and making large numbers of Americans unemployable. That we're experiencing this transition from an industrial to a post-industrial society, and we still have an educational system that's rooted in the 20th century industrial world. And we need to jump on this right away, because there's no asset that takes longer to develop than a human capital. You can build an office building or a factory in a few years, but to build a PhD, that takes 20 years or 30 years, you know? So we have to recognize that the script for the U.S. economy is being written in our high schools right now. The script for the next couple decades. That's not a happy story. We're falling behind in that global race. So that's the main message here. So this is a slide, I'm sure you've seen a version of it, but this is the way of saying the Fed has made dramatic injections of liquidity into the commercial banking system and to no avail. And if you've had your third dose of leeches and it isn't working, maybe you think you've got another disease. So I don't think anything the Fed is doing has had any significant impact. It's not likely to have any significant impact because it doesn't treat the workforce development problem that we have. And then what about the fiscal stimulus? This is the receipts as a ratio of GDP, and this is federal spending as a ratio of GDP. The fiscal stimulus is when we had an all-time high ratio of spending as a share of GDP and a virtually all-time low share of taxes as a share of GDP. And you can see the fiscal cliff here at the very end. That closes a part of the gap, but it still leaves a very substantial lingering deficit. We tried that huge fiscal surplus, fiscal deficit, that big stimulus package. It didn't work. Maybe something else is the problem, which I'm going to try to articulate here. It's a workforce development problem. And the key thing you got to understand is not this recession that's different. It's the last 3 recessions. The Reinhardt-Rogoff guy idea is this one is different, but the last 3 have been different. You think about what's appropriate medicine. That's the critical, the critical piece of evidence. The last 3 recoveries have been very rapid, like a rabbit, and the last 8, and the first 8, and then the last 2 have been turtles. Let me say that again. The last 3 have been rabbits. The first 8, okay. Okay, I got to get my high school degree going again. The first 8 since World War II have been like the rabbit. The last 3 have been the turtles. So here's the story. In fact, we already saw something like this. This is I'm going to show you an image of real GDP. That represents a normal or hypothetically normal 3% growth rate. And that's what happened after the peak in 1948 Q4, in which you dip down by a couple percentage points, and then you have to have supernormal growth in order to get you back to that 3% trend. That's 1948, that's 1953, that's 57, that's 60, that's 69, that's 73, that's 80, and that's 81. And that circle is where the recovery is occurring, where you're having supernormal growth, where you're putting people back to work. So all of those first 8 recoveries, all the first 8 recessions had real recoveries. But let's take a look at the last 3. Again, with the normal growth, that was 2001. It took us deep into that expansion before we got back to that trend rate of growth. It took a bubble, the internet bubble, to get us back to that trend growth. But inside the circle, there's no recovery. That was 1990. This is 2001. And this is where we are now, which is worse, for sure, in terms of the amount of dip and the fact that we're not closing that gap. There's been no recovery. The gap between where we should be and where we are is widening. But the thing is, when you think about the medicine, you got to think about the last 3 have been different. Not just the last one, but the last 3. And we can see this in the payroll data too. Here's the payroll data. And that's the 1990. The last one is 1990. It took us almost 3 years to get back to where we were before. This is 2000, where it took us 4 years to get back to the payroll level. And here we are now. And so that's a lot worse. But the last 3 have been sluggish. And industrial production is the same thing. So this is the first 8 recessions, with that circle representing that strong recovery. And here's the last 3. I mean, the one we're in now is the one at the bottom. That's worse, for sure. But what it has in common is no recovery. So why is that? And here's what I'm suggesting. It has to do with the transition from industrial to a post-industrial world. What you see here is the employment and manufacturing. And it is V, 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 V. Each one of these recessions, you lose a couple million jobs, you have temporary layoffs, followed by recalls to exactly the same jobs. That's an easy thing to do. Every one of these recessions also has some permanent displacements. The difference between a permanent displacement and a recall is a displaced worker has to choose a new location, new skills, and probably new aspirations, because they're going to go to a job that is not so appealing as the one that they had. That takes time. That's a problem that's not very amenable to demand management policies on the part of either the Fed or the fiscal authorities. So it's V, 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 V. The first time we had an inkling that something was different was in 1990, where it was a U. We didn't get any significant recovery until we really ignited that internet rush in 1995, 1996. Then in the recession of 2001, it's a huge L. We lost a couple million jobs and none of them came back. You must know that living in the Midwest. We don't feel it so much in California, but this is the story of the Midwest. This is another one of these L. We're getting some recovery. That's durable manufacturing, automobiles, some recovery this time, but we're not going to get all those jobs back. And you want to capture this idea in a picture. We've got a positive secular trend followed by a negative secular trend. That's the period of deindustrialization as far as work is concerned. So the reason that changes the cycle is illustrated here. These events always involve cost cutting, in which you lay off more workers in the first stroke of the V, you lay off a bunch of workers, and you hire some of them back, not all. The operations that I know in the Inland Empire in California are producing about 70% of their previous peak output with 50% of the workforce. So that's the productivity gain that always happens during these cycles because businesses focus on cost cutting during the recessions. But if you add to that a positive trend, then you get a nice V-shaped, comfortable kind of recession recovery in which people go back and do exactly the same work. And they recognize they're going to get recalled, and it's not a big issue. But if you take the cost cutting and you add to that a negative secular trend, then you get the kind of lazy L's that we're getting. So this is the experience of transitioning from an industrial to a post-industrial world. And this one is a complicated graph. I hope I can get it across. The horizontal axis is the hours, total hours worked in the economy. The vertical axis is total output. So those rays coming from the origin, those are lines of constant productivity, meaning output per hour is constant. So you kind of think when the U.S. economy is going to grow, it means more output and more hours, so it's going to move up in the northeasterly direction. And it's probably going to get higher and higher productivity because that's what technological change and better management styles do. So that's the image that you're going to have. But up in the upper left, that's the recession shape. In recessions, you cut back hours a lot more than you do output, and then this thing gets turned around and you have both hours and output growing together. Hope you all get that. So here's the 1948 expansion. You can see it starts off with that little wiggle. That's the cost cutting in recession, and then you're up and running. That's 1953, 57. That was the Kennedy-Johnson expansion in the 60s in which you had a big improvement of productivity. Then it's 69, 73, 80, 81, 90. Can you see the 90 cycle? The cost-cutting cycle is bigger. Firms were able to do a bigger cost-cutting cycle in 1990. And then this is 2001 with a huge cost-cutting cycle. And this is the one we're in now with another one of these huge cycles. So something has changed about the technology which allows firms to engage in a whole lot more cost-cutting during these recessions than they had before. Well, you know what that is. Instead of hiring workers, they're putting in electronic equipment. They're using microprocessors instead of workers. So that changes the cycle, makes the cost-cutting more extreme, makes it harder to get your job back. But the critical thing in this slide is that we've got, in the 21st century, both hours and output growing together. But in the 21st century, it's all output and no hours. That's the microprocessor. Humans are so unnecessary in the post-industrial world that we're living in. Or to put it another way, you've got to make sure that these high school kids have to bring to the labor force something that microprocessors can't do. And that means they have to be creative, problem-solving. They have to know how to solve the problems of the future, not the problems of the past. So here I got a little I got a little image to drive this point home. Can we play this video? Somebody hit that, somebody back there, or we sleep at the switch? Here we go.
A Chinese restaurateur in Beijing has invented a robot chef to make sliced noodles. Tsai Rong-an came up with the idea of a robotic chef in 2006 while working at his restaurant. After a few months, his idea became reality. Chef Tsai is the fourth incarnation of his robot. It works on the same principle as a set of windscreen wipers, shaving with up and down movements.
Okay, we can move on. That's a symptom. That's what you see is their technology in action. That's creative destruction. If you were a noodle maker, all of a sudden you're competing with a piece of equipment. So our kids have to graduate from high school. They can't be noodle makers. That's part of the 20th century. So you have to deal particularly with that microprocessor that sits on all their desks, inside all their equipment, and recognizing that all the mundane, programmable, codifiable tasks, whether physical or intellectual, that's going to be done by equipment. And you've got to bring distinctly human activities. It might be social, but problem solving, analytical building, and oh, this is the other slide that really is alarming. So workforce development, we got to invest in these kids. We got to get the high school in our country up to snuff, and in the colleges too. But the other place that you learn how to work is on your first job. You don't really learn that much about work in the colleges and high schools, but we have record low employment to population ratios of our kids. So that's the 16 to 17-year-olds who not long ago, 40% of them were employed. Now we're down to about 12%. That's where you learn job skills. The 18 to 19-year-olds, we've never had such a low employment to population ratio for these kids. The 20 to 24-year-olds, almost a record low. So we're doing two things wrong with regard to the kids. First of all, we're not giving them adequate education. And secondly, we're not giving them access to that critical first job. They carry that with them throughout their whole life. So if you're an employer, do America some good and hire a kid. Even if you don't pay them, that's a good thing too, and as an intern. So the message is we need better leadership focused on the longer run. The U.S. economy has a record number of permanently displaced workers. Expect the unemployment rate to be very persistent. We don't see it dropping very rapidly because if you're a Midwestern manufacturer and you lost your job, your next best alternative might be a gardener in Texas. And that is a tough transition, and it doesn't happen rapidly. We've got 2.5 million jobs in manufacturing, probably 2 million in construction, maybe 1 million in retail, permanent displacements. The microprocessors changing the labor market dramatically. It takes a special kind of education, not training, but real human education. I guess that's the message here. So our forecast, one more thing about housing, and then we'll come to the forecast. So housing has two markets you have to realize. There's a market for place to live. So think of that as a rental market. You may own the house, but you're renting it to yourself. So one market is for places to live. There's a separate market for who owns those places to live, an asset market. Most of what you hear about the overhang is about the asset market. Who's going to own the losses in residential real estate? Are we going to have investors buy these distressed properties and rent them out? That's an issue in the asset market. But in the rental market, what you want to look at is the number of households compared with the number of places to live. If you have more households than you have a place to live, that's a situation of excess demand, and it's going to realize itself in higher rents and then higher asset prices as well. So that's exactly, these two sides are saying that at the peak of the housing market, we had about 1 million excess units compared to trend. But in 2008, household formation came to a crashing halt, and we ended up with about 3 million missing households and about 3 million missing houses. So it was kind of a balance. That market for a place to live was balanced, but the labor market is improving now, and households are forming again. So it used to be grandma and grandpa moved in with mom and dad, the kids moved in as well. Those 3-generation households are starting to break up, and that's what's causing the improvement in the housing market, which we think will be substantial going forward. So in terms of a forecast, we've got 2.4% through the end of 2013. The state and local government continues to be a drag on growth. We see housing improving. I don't think any of us disagrees very much as to what our basic forecast is. We think unemployment is going to be pretty sticky. 7.7 might be optimistic about 2013 Q4, given the reality of the displaced workers. Fed funds rate is going to stay on the floor. Nobody knows when the Fed is going to be compelled to raise those interest rates, and probably not before the end of 2014. The 10-year Treasury has to go up. We see little upside risk for the forecast. Housing could recover a little earlier, but other than that, not a whole lot of upside risk. And the European, what we think is mostly psychological contagion, is a potentially serious downside. Not so much real, because we don't export enough to Europe to matter that much for U.S. GDP growth. So I had some comments about what I talked about is the structural adjustment from industrial to post-industrial. But the other structural adjustment, which we've not made any progress on, is from a spending society to a savings society. Do I have another 5 minutes? Okay. This is a forecast that none of you are going to believe. I have complete confidence in it, and I can't understand why you don't believe it. A year from now, you're going to be a year older. And the reason I know you're not going to believe it is because you're just like all Americans, is you're not saving for your retirements and taking care of yourself when you become elderly. Yet the country, this is the age distribution of the United States, and at the top, that's the elderly. So this is where we are. The vertical line is where we are now. We go to the right, that's what it's going to be like in 20 or 30 years. There's a big increase in the most elderly, the 80 and above, as a share of the population. And they're very expensive to take care of. We need to prepare for that reality in the old-fashioned way, which means save, save, save. But our national savings rate, this is net national savings, includes Uncle Sam, who's the biggest saver of them all. Our net national savings is basically zero after going through a period of negative, meaning we're completely unprepared for the reality of these retirements. So we need to rein in Uncle Sam. We need as individuals to recognize that our personal savings rate is weak, 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 and we got to get that up. The corporate savings through retained earning is fine, but Uncle Sam is really a badly behaved actor as far as savings is concerned. So you think about where is this correction on the spending side going to come from? We've kind of heard this before, but this is the federal spending as a fraction of revenue. There's a 100% bar in there. If you go above that, then you're in a deficit. You spent more than you earned. So let's go through. This is veterans benefit, which is important back in the 30s when you had all those World War I retirees, but not so important now. There's the unemployment benefits. We complain about that, but it doesn't, not very much. Refundable tax credits, other, railroad retirement, military medical insurance, workers' comp, pension benefit guarantee, veterans life insurance, black lung benefits, direct relief, supplements to Social Security, nutritional supplements. That's the first big one. That's Social Security. That's the next one, which is Medicare. That's the next one, which is Medicaid, grants to the states. It's taking care of the elderly and the poor as far as medicine is concerned. And then we add to a couple more. That's defense. You can argue that defense spending ought to be on the chopping block as well. And you keep on adding the investment components. And at the very top is the interest payments. And they add up to 150% of revenue. The transfers themselves add up to 100%. Without spending a penny for the Commerce Department, the Department of Transportation, you've already exhausted the total revenues of the federal government. And we're up to 150% of revenue. So you tell me where that money has going to come from. It's got to come from the elderly, Medicare and Social Security, and maybe some sensible defense cutbacks. But if we don't, that interest, that little sliver at the top is red. That's small because interest rates are low. And that's going to get fat even if we don't do anything, or even if we don't run any more deficits. It's going to become a whole lot fatter, which means eating up more of the revenue, putting a higher and higher tax burden on our kids. So to wrap this up, here's what the election is all about. You got to be alert back there. The question is who's going to pay for their schooling and who's going to pay for their Viagra? And right now, you know how it's been going. The kids are going into debt to pay for their schooling, and we're piling up huge benefits for the elderly. Thank you very much.
And finally, we have Dr. Kate Warren. Dr. Kate Warren has been with Edward D. Jones for the last 15 years. She's the firm's investment strategist. She interprets market conditions and recommends appropriate long-term investment strategies. She holds a doctorate in economics, specializing in finance and competitive strategy from Yale University, and was formerly an economist with the President's Economic Council of Economic Advisor. Would you welcome Dr. Kate Warren?
Thanks very much, Julie. I'm delighted to be here today, and it's sort of interesting. Ed talked about what we need to do. I'm going to talk about things being pretty much the same because I don't think we're going to do many of the things he proposed that we need to do, at least anytime soon. You've heard, and he showed really interestingly, all of the recessions and the recoveries we've had since the Second World War. Well, we've heard a lot about this recovery from recession being a lot slower than average. All I did was look at the average. The average on this chart is gray. The current experience is the blue line. You can certainly see what everybody's talking about, which is this recovery from the last recession is a lot slower than what we've seen historically. But it's kept moving forward. It's just been way below what anyone expected based on that past experience. When we look at the quarterly GDP growth rates, you can certainly see the impact of Great Recession, and you saw those in Jim Bullard's chart as well with a longer time frame. We've just color-coded them, the Great Recession in red, the green being our current experience where we see growth at around a little above 2% on an average basis. And then this is the consensus forecast through the end of next year over the next 6 quarters. I want to make 2 points about forecasts. At Edward Jones, we don't actually do specific economic forecasts. That's why I've got the consensus up here. Second, they're always smoother than reality. So reality is bumpy. Reality is always a bit of back and forth, but all the forecasts look like it's really nice and smooth, and they almost always show it's going to be faster in the future. Now, that's been true over the last few years, so keep in mind that it doesn't always accelerate like this kind of picture makes it seem. We do think that what we're going to continue to see is modest economic growth, but it's more of the same. It's around that 2% level. And that also means that the employment picture that we've heard a lot about, this is the payroll growth rather than the unemployment rate. These numbers come out same time, first Friday of every month. We're going to continue to see something in the range of 100 to 150,000 jobs created each month. Not enough to lower the unemployment rate dramatically, but the same sort of slow progress that we've seen. Positive, moving in the right direction, but disappointing. When we try to figure out why the economy is doing this, and I would certainly say that Ed had some points that I don't typically make. What I look at is the fact that the cyclical sectors of the economy, the ones that really drive the economic cycles over time, as opposed to the underlying trend growth, really haven't recovered as they typically do. This is new home sales. You actually saw a lot of the housing data in the previous presentations, but we just picked one. They all look pretty much the same. And again, what I use is this recovery compared in blue, compared to the average of the past 10 recoveries from recession in gray. By the way, we all notice that we all use the Fed's FRED database. I always have struggle over saying that. So I want to say thank you to the St. Louis Fed because it makes it so much easier and it gives us all a consistent base for that data. But again, this is from the FRED database that gives us this wonderful data. Do you see any pickup in housing and new home sales here as the economy recovered? Blue line growing very much? Not until just recently, right? So we do think that housing is finally starting to turn the corner. We do think that housing will be a positive contributor to growth going forward, but it's a couple of years late and it's likely to continue to be slow and sluggish. It's not suddenly going to rebound like we've seen before. And that's why we keep looking at this and saying, modest growth going forward, the composition's likely to shift around because some of the other cyclical parts of the economy picked up earlier and now they're slowing down. But that net still gives us that 2% or so growth rate. There's another thing to keep in mind, which is the Federal Reserve, as we all know, has said they'll keep short-term rates low through the middle of 2015. If you take a look at the impact of not just short-term rates, but low long-term rates on the economy, one of the measures is the consumer debt service ratio. You can see it's gone from near a record high back in 2007 to about a record low today. Think about a low mortgage rate. What does that mean for your mortgage payment? Smaller, right? That means you have more money to spend on other things. And we think that's part of why consumer spending, which is 70% of the economy, has continued to grow at a reasonable pace, even though consumers continue to have huge mountains of debt. It's that low interest rate environment that's actually been a backdrop, a positive tailwind. That's been true for the past 30 years. Long-term interest rates in blue, short-term interest rates in red, but you can see that downward trend. In fact, we've all spent lives in an environment of falling interest rates. We don't think that's going to characterize the next 30 years, so we are concerned about what happens. But short term, we don't see much, again, in the way of a change. The two things we're watching in terms of when will long-term rates pick up, which we do think will occur before the Fed raises short-term rates, are what's going on in Europe. We don't see the debt troubles as solved there. And second, could we see a pickup in inflation? We don't see much of that either right now. When you look at inflation, again, with a longer-term perspective, you can see inflation rates came down dramatically back in the early 1980s, then fell again in the 90s. But we've lived in this environment where both core inflation, again in red here, overall CPI that includes the food and energy and bounces more, both have stayed remarkably contained. We think that's likely to occur in the future as well. In other words, we're looking at this and seeing not many catalysts that suggest that inflation is picking up. We also look at the TIPS versus the Treasury as a measure of inflation expectations. And as you saw in Dr. Bullard's presentation, not much of a pickup there. They are around 2.75% in terms of what they're expecting inflation to be. Current inflation is a little below that. But again, we're not seeing much of a reaction in the market, much of a catalyst for higher inflation going forward. So when we're looking at the economy, we see a continuation of modest growth, sort of a lukewarm economy. That means unemployment doesn't change very much. It means that inflation and interest rates also don't change very much over the next year. But I didn't want to just give you sort of our baseline. I wanted to talk some about the risks that we see that make that different. And they really center around the high levels of federal debt, both here and in the rest of the world. Debt, and this is net debt, not gross debt, for the US, and the Eurozone on this chart. The US in blue, the Eurozone in red. Note that the US is actually above the Eurozone, where we hear so much about Spain and about Greece and their inability for governments to pay their debts there. So I'll talk first about the Eurozone, then talk about the US and the fiscal cliff. When we look at Europe, we're certainly delighted that Europe's debt troubles seem to be less in the news these days. But Europe really has embarked on a policy of austerity, trying to cut government spending dramatically, particularly in the southern part of Europe, in order to bring down government spending, government deficits, and address long-term debt problems. As a result, most of Europe is in recession. We saw that in one of the earlier slides. We think one of the big differences between the last 2 years, where Europe did cause an increase in financial volatility, caused worries about an entire meltdown in the world, versus this year, is the change in European Central Bank policy that Jim Bullard also mentioned. Basically, Draghi has said he'll provide liquidity to the banks. He's going to make sure that he maintains the Eurozone. That, in our view, says Eurozone leaders are likely still to be very slow in addressing the problems. We do expect that Greece, Spain, other countries are probably going to ask for bailout money. That creates financial risk, but the risk of a financial meltdown is a lot less than it was before. So bottom line, we think that we continue to see volatility out of Europe. Don't think that the markets are calm about that, but we haven't seen much of that this year. And as a result, we think many people who are thinking about the investment implications actually ought to be thinking about increasing their international investments. That if Europe just causes volatility and doesn't cause another financial crisis, there's actually an opportunity in Europe. Now, the European approach, austerity, put the economies into recession. And at the end of the year, the US could do the same thing, instant austerity. The fiscal cliff, which we hear so much about, is really explained. So let me take just a minute to talk about what it really is. At the end of the year, if Congress doesn't act, if Congress does nothing, we see an increase in tax rates on personal income, dividends, and capital gains. So taxes go up automatically if Congress does nothing. In addition, the federal estate tax exclusion goes from above $5 million down to $1 million. And sequestration, that big word that essentially says defense spending cuts and non-defense discretionary spending cuts also go into effect. CBO has estimated that at around $5 billion, or about 3.1% of GDP. If that weren't enough, we hit the debt ceiling again in, people are now estimating, February of 2013. The combined impact, in our view, says if Congress does nothing, we're likely to see a recession early next year. But keep in mind, we're talking about a fiscal cliff, not an economic cliff, and not a market cliff. And I think people do confuse those. So let's look at the graph. This is the federal deficit, the annual numbers. We know that we've run deficits of above $1 trillion for the last 4 years. The fiscal cliff in red there is simply the deficit would shrink by almost half, down to from above 7% of GDP down to about 4% of GDP. The interesting thing is that I've had lots of people say to me, I'm really worried about the fiscal cliff, but I wish Congress would do something to address the deficit. That suggests to me that people don't understand that the fiscal cliff is just a significant cut in the federal deficit. CBO did some estimates, which I've got here, suggesting that if that is the case, if Congress doesn't act and we experience the full fiscal cliff, that we also experience recession in 2013. The purple or the dark red is their estimates of the economy with the fiscal cliff. What you can see is it's 2 quarters of negative GDP growth. That's the first circle on the left. And the blue is sort of the baseline, the consensus that we would see in the event that Congress does act and we don't cut the deficit so significantly. This would be a milder and shorter recession than average, but once you get into that kind of territory, nobody knows for sure. In addition, the thing that was also interesting was with such a sharp contraction in the role of the federal government in 2013, look at the 2014 forecasts out on the second circle. Growth is actually stronger, according to these estimates, in 2014. And that's because the dampening effect of the cutbacks in the federal deficit that everybody builds into their forecasts right now actually are less in 2014 if there's a severe cut in 2013. We don't know what Congress will do at the end of the year. There's 2 ways of thinking about it. The first is, historically, Congress has got to the edge of the cliff, said, my gosh, we don't want to cause a recession, and decided to kick the can down the road. That's what most people think. That's what we build into the forecast. That's what you're seeing from all my colleagues as well. On the other hand, this Congress has been notorious for not getting anything done. So some people think that they'll get to the end of the year and just say, not our problem. All these things go into effect automatically. Nobody knows. We thought it was worth paying attention to and alerting people because we actually think that there is something as investors that you can do between now and the end of the year. The first is to be sure that you're taking full advantage of after-tax or tax-advantaged investments. That's IRAs, 401ks, and education savings accounts. For those of you who aren't working yet, this is what Julie was talking about in terms of being sure that you're saving over time. These are different ways of saving, but most of them require that you have current income. We also think it makes a lot of sense to focus on municipal bonds, to think about Roth IRA conversions if appropriate, and despite the potential increase in dividend tax rates, to pay attention to and own dividend-paying stocks with the potential for dividend growth over time. What we don't know is when Congress really gets around to doing things, what they're going to tax. What you're looking for is tax diversification. There's another point to make, which is that many people do their year-end tax planning in December. We'd suggest doing it now before the election because we think the market's going to focus on this between November and the end of the year. That could lead to market volatility, down when the market begins to worry about what Congress might do, and then potentially a rebound when, in fact, Congress either does or doesn't act, depending on the situation. If you have an over-concentrated position, think about reducing it now because capital gains taxes may go up, if not at the end of the year, in the future. And second, typically people offset gains with losses, realized losses, realized gains. This might be a year where you want to think about doing something different. All right, now you would think, of course, that the election would be about all of these issues. It sort of is and sort of isn't. But one of the things I wanted to mention is while I think Europe is a risk to our forecast and the fiscal cliff is a second risk, many people think the election is a third differentiator. We think not. We actually think that the election doesn't matter nearly as much as people think for the path of the economy going forward. But we do think people are hesitating, and they think the uncertainty will be resolved in November. We think that's actually pretty unlikely. When we looked at the political combinations in Washington, the party of the presidency, party of Congress, and we looked at all the combinations that have been there since 1900, The really interesting thing was that the stock market, that's the third column, the Dow Jones Industrial Average, has grown on average under all combinations, no negative numbers in that third column, and industrial production, representing the economy, also has grown on average over time. That's not to say politics doesn't matter, because there are clearly differences. What it is to say is that the forces that affect the economy and the markets tend to be stronger, and the system of checks and balances actually tends to weigh more than the political parties. You can look at this another way, looking at the change in the party of the presidency since 1947. Been 8 changes in the party of the presidency along the bottom. But the economy in gray there and the stock market in green both have tended to trend higher. Again, it's bumpy on the stock market. It's not always the same. But the things that drive long-term market and economic growth tend to be stronger than the changes in the party of the presidency or Congress. That's not what you hear during election season. But I think it's really important to keep it in mind when everyone's saying this could make all the difference in what we see in the economy over the next year or two. It'll make some differences. It may make less in terms of the things that affect your investment decisions. I'm going to use my last few minutes to talk about the stock market. I showed you the charts that showed that the economy has been a lot weaker in this recovery from recession than past recoveries. And Ed showed you in great detail some of those same charts. Interestingly enough, the stock market's actually done better than average in this recovery from recession. Stock market this time in green, the average of the past 10 recoveries from recession in gray. It's bounced along. We think that it's partly driven by stronger earnings. And you can see that in the price-earnings ratio. Price-earnings ratio in the S&P 500 right now, 13 times, historical average 15 times. Stocks aren't as cheap or aren't as attractively valued as they were a year ago or 6 months ago. We still think they're attractive. And when we look out, while we see third quarter earnings looking less strong, we still see earnings growth going forward. That says to us, and as Julie made the point earlier, there's really no other great place to put your money. Stocks really are the right place for long-term investors. But short term, we expect to return to normal market volatility, because we do think that when we look at this year, what we've seen is just one of those dips. And the market tends to have how many dips each year? Those 5% declines? 3 to 4. That's on the slide. How many corrections do we see each year? 10% declines. About 1. And we've seen 0. Now, fortunately, the stock market doesn't have to catch up by the end of the year. But we do think it's very likely we'll get back to a more normal, volatile environment. That doesn't say sell, it says stay invested, because you're just returning to a normal stock market environment. And over this entire time, with those dips and corrections and even bear markets, stock markets returned a little less than 10% per year. In our view, there's a lot of uncertainty out there. There's particularly a lot of policy uncertainty. What do you do as an investor in an environment where there's more uncertainty? Well, you want to build a slightly stronger foundation to your portfolio that says improve its diversification and rebalance back to your target asset allocation, your target mix of stocks and bonds a little more frequently. Make sure you don't let the policy uncertainty distract you from your long-term financial goals, because you know that's the kind of thing that'll lead to an emotional response. And last, look for companies and funds that are able to chart a course through it. They'll still be affected by all the macro uncertainty, but they could be a little less affected. Bottom line is we see the economy being lukewarm, neither hot nor cold, this continuation of modest growth. But we think the Federal Reserve's policy, always seeming to step in whenever they see growth faltering, really gives a lot of comfort to longer-term investors. 2 key downside risks are from European uncertainty and from the possibility of the fiscal cliff at the end of the year. But the election really is not a source of big uncertainty, so don't let your politics affect your investment decisions. Bottom line, in this environment, we think equities are attractive, and you'll see that in the forecasts we do later. Thanks very much.